Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to Through the Noise. Now, there was a lot of excitement last week in financial markets after the release of the US inflation data, which showed that the pace of inflation was starting to slow. Unsurprisingly, equity markets were up, and bond yields and the US dollar were down shortly after the release. Now, fighting inflation has been a key priority for major central banks like the Fed, and it's a good time to remind ourselves why this is so. Uh, just as a simple back of the envelope calculation, if an annualized inflation rate of 3.5%, for example, actually means that prices double every 20 years or so. That's why central banks can be so focused on inflation. But actually, for a lot of us, that's also an important reason why getting and staying invested can be so important to preserving one's purchasing power. Now, that's of course the big picture, but more tactically, how does this US inflation data impact our investment views and does it change anything? To help answer that question, today we'll speak with Rajat, who runs strategy for the CIO office on this topic. So, welcome, Rajat. Thanks for joining us today. As we just, as I mentioned at the start, so markets have rallied, but of course, our investment view is still a more balanced approach, which is something we see as more prudent. Can you help our listeners understand why is that, and why are we not advocating just simply chasing equity markets higher?
Hi, Manpreet. Yeah, glad to be here. You're right that markets have cheered the softer than estimated in U.S. inflation and jobs report on expectation that an end to Fed tightening is near and the economy is headed for a soft landing. Now, the disinflationary trend is likely to boost real, by that I mean inflation adjusted incomes and consumption, potentially supporting longer term growth. This was a key reason why we pushed back US recession expectations to Q1 2024 from later half of this year. Strong momentum and institutional cash on the sidelines could drive the risk asset rally higher in the coming weeks, spurred by the fear of missing out. We've all heard about the FOMO factor. This is especially so if US second quarter earnings, which starts in earnest today, surpasses beaten down expectations. The current consensus estimate for second quarter US earnings is minus 6.4%. So the question, as you said, is why still maintain a balanced allocation and not chase the risk assets higher? We believe there are three reasons for staying with a balanced allocation, despite being positive on equity markets in the near term. First is the tighter real policy rates. The ongoing disinflation is likely to tighten the inflation adjusted policy rates. Measures of US real policy rates, adjusted especially for longer term inflation expectations, which are still anchored, are already above the Fed's estimated neutral rate. The neutral rate is the rate at which the Fed tries to keep the economy from overheating. There are also signs that the steep rate hikes of the past year in the US and Europe are starting to impact job markets. Now, the second reason for us still staying balanced and not chasing the risk assets higher is new estimates from the San Francisco Fed and other independent researchers suggest household excess savings are dwindling fast and could be drained, especially for the lower and medium income households, by the fourth quarter of this year or early next year, removing a key prop supporting the US economy. Now, and the third factor is resolutely hawkish central banks. Now, developed market central banks, particularly I mean the Fed and the ECB, appear focused on bringing inflation back towards the 2% target, even at the cost of growth. This suggests policy is likely to remain a headwind for risk assets for the rest of the year until the Fed and the ECB relent and cut rates.
Thanks, Rajat. I think interesting sort of case, especially on the equity side. But the other observation we had in markets was that when we had the inflation release, bond yields also fell sharply. And the question really is, do you see that move lower help reinforce our existing conviction, high quality bonds? I mean, is there anything we can learn from short term technicals?
Yeah, sure. That's correct. That the 10-year government bond yield from the US has pulled back sharply from just above 4% levels over the past week. Tactically, we think that the risk reward balance now favors adding to developed market government bonds. By that, we mean really US and European government bonds and Asia dollar corporate bonds. High quality bonds are relatively cheap compared with equities, especially in the US and Europe. On the technical charts, like you mentioned, the US 10-year government bond yield has failed to sustainably break above 4%, marking a key resistance level. Key near-term support levels for the 10-year bond sits at around 3.82% and 3.69%. Long-term yields are unlikely to go much higher even if the Fed hikes by, let's say, around 25 to 50 basis points. If anything, slowing growth and disinflationary pressures, including and increasingly from China, are likely to drag long-term bond yields lower. Hence, they are likely to provide capital gains on top of attractive yields, outperforming cash over the longer term.
Okay, I wanted to pick up on two things you spoke about, of course, Asia dollar bonds and, of course, potential deflationary pressures from China. Now, I think what was interesting in China, of course, we saw some policy measures extending, at least some past property measures, past measures rather aimed at supporting the property sector. I know it's a small sector, but what impact do you see from those property sector measures on Asia dollar bonds, if any?
Yes, the PBOC, the Chinese central bank, recently extended two policies that were set to expire within the 16-point plan that was implemented last November to support the ailing property sector. Broadly, they involve extending the maturity of the existing construction and trust loans by 1 year, with no change to risk classifications in developer loan books. Now, we believe the policy measure is likely to have limited impact on the property sector, given that it's not a new measure and is relatively small scale in nature. Moreover, there has been a lack of material policy easing in the property sector so far this year. Hence, we remain cautious on the China property sector bonds. Within bonds, though, as I mentioned earlier, we retain our preference for Asia dollar denominated bonds with the goal of obtaining exposure to high quality bonds. As you recall from our past conversations, this asset class, this Asia dollar bonds asset class, comprises about 85% investment grade bonds. The China real estate sector really remains a very small part of this universe. It's about 4% of that entire universe.
Thanks. Yes, that's a good point. I mean, obviously an important sector macroeconomically, but quite small, as as you point out, as a share of the overall asset class. But what about Chinese equities? I mean, the real estate measures, of course, are still one factor there, but geopolitics has been a concern. But following, U.S. Treasury Secretary Yellen's visit, I mean, sentiment seems to have improved quite a bit.
Indeed, Chinese equities outperformed actually global equities in the past week, which is a reversal of their underperformance, as we know, year to date. This follows that positive tone that you talked about from the US Secretary Yellen's visit to China, and also because of pro growth comments from Premier Li Qiang and supportive policy measures for the property sector from the Chinese central bank that I talked about. Now, we expect a further targeted stimulus measures at the upcoming Politburo meeting later this month. We believe the most attractive way to position in China equities is for a consumption rebound. As such, we are overweight on the communication services and consumer discretionary sectors. We believe these sectors will benefit from greater consumer spending and regulatory support. Both these sectors are dominated by internet platform companies that are increasingly recognized by policymakers as growth engines for the economy. Premier Li Qiang, for instance, recently called them trailblazers of the era. In addition, the automobile sector, which is buoyed by the transition to new energy vehicles, accounts for 18% of China's discretionary sector. This particular new energy vehicles industry has been recognized by the government as a key strategic industry that can help boost consumption and investment. China has been the target, has been, I should say, the largest new energy vehicle producer globally since 2015 and became a net car exporter in 2020. We expect global demand for new energy vehicles to continue to rise, which is supportive of our overweight view on the discretionary sector.
uh, Net automotive exporter, I think that's definitely notable. But all right, just very quickly though, before we end today's podcast, pound sterling is jumped quite a bit in recent weeks as markets were focused on the likelihood of higher Bank of England rates. Is that something you'd chase higher?
Not really. While rate differentials have indeed driven the sterling higher in recent weeks. In fact, sterling has been the best performer amongst the major currencies year to date. The UK faces heightened risk of a recession in the second half as the Bank of England drives rates higher to quell demand and bring inflation back to its 2% target. Therefore, we expect the Bank of England to adopt a more cautious approach to policy tightening and hike rates by less than what the markets are expecting. As we have spoken earlier, that the BOE is expecting around 150 basis points of another 150 basis points of rate hikes from here. We don't think they're going to get there. Now, technically, the sterling USD pair, the cable, looks overbought with the momentum indicator, the RSI, staying over 70. Now, the pair is also testing the upper limit of the long term ascending regression channel, with a resistance of around 1.2990. Both are likely to trigger a downward correction. So we now expect the pair to test its near-term support of around 1.2850. So we have a bearish call actually on the sterling against the on the Sing dollar. That's a short-term call though. But overall, we are turning more bearish in the short term on the sterling.
Okay, thanks, Rajat. I think we'll have to end it there. That's all we have time for today. But as always, maybe it's a good conversation. But if I can sum up what were the big takeaways for me at least, I think number one, of course, markets, of course, rallying on the risk asset side. But from our point of view, we just think a more balanced approach is more prudent than just blindly chasing equity momentum higher. That's the first one. A second one, of course, that in China, we've got some policy support, a moderate one in the real estate sector, perhaps a little more forthcoming. But of course, that should be positive for Chinese equities and Asia dollar bonds broadly. And finally, of course, as you just mentioned, a pound sterling may be a little bit overbought. And in the short term, at least, we'd be looking for a pullback. So we'll end it there. Thanks, Rajat, for joining us today. And thank you, listeners, of course, for taking your time to listen in. Have a great week ahead, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.